Welcome to The Bag, the channel where we break down everything you need to know about money, wealth, and financial freedom. Today, we're taking you on a journey through time to explore one of the most fascinating and essential aspects of human civilization: the evolution of money. From ancient bartering systems to the rise of digital currencies like Bitcoin, understanding the history of money is key to grasping its role in our lives today. So sit back, relax, and don't forget to hit that like button, share this video with your friends, and subscribe to The Bag for more insightful content. Long before coins, paper money, and credit cards, people relied on a simple system to acquire goods and services: bartering. The barter system, dating back to at least 6000 BCE, was humanity's first attempt at economic exchange. Instead of using money, people traded goods and services directly. For example, a farmer with excess grain might trade with a hunter who had surplus meat. This direct exchange seemed straightforward, but it had significant limitations. One of the major challenges of bartering was the double coincidence of wants. This means that for a trade to occur, both parties had to have something the other wanted at the same time. If the hunter didn't need grain, the farmer was out of luck. Additionally, determining the value of different goods and services was often subjective and inconsistent, making fair exchanges difficult. Despite its flaws, bartering was the foundation of early economies and laid the groundwork for the development of more sophisticated forms of trade. As societies became more complex, the limitations of barter became increasingly evident. This led to the development of commodity money, objects that held intrinsic value and could be widely accepted as a medium of exchange. Various items served as commodity money in different cultures, including livestock, grain, shells, and precious metals. One of the earliest examples of commodity money was cowrie shells, used in various parts of Africa, Asia, and the Indian Ocean region. These shells were durable, portable, and relatively rare, making them suitable for trade. Similarly, in ancient Mesopotamia, barley was commonly used as a form of money, with its value measured in units known as shekels. The use of precious metals, particularly gold and silver, as money marked a significant development in the history of currency. These metals were valued for their rarity, divisibility, durability, and ease of transport. They became the basis for early forms of coinage, which would eventually lead to the creation of standardized currency systems. The invention of coinage around the 7th century BCE in the ancient kingdom of Lydia, in modern-day Turkey, marked a crucial turning point in the history of money. Coins were standardized pieces of metal, typically gold or silver, stamped with symbols or images to denote their value and authenticity. This innovation solved many problems associated with barter and commodity money, such as the need for mutual wants and the difficulty of determining value. The use of coins spread rapidly across the ancient world, particularly in Greece, Persia, and Rome. Coins not only facilitated trade but also played a vital role in the expansion of empires. Rulers and governments could mint their coins, bearing their images and symbols, which served as a means of asserting authority and control over vast territories. Coins also introduced the concept of money as a store of value, a unit of account, and a medium of exchange, all essential functions of money in modern economies. The Roman Empire, for example, developed a complex and extensive coinage system that became the backbone of its economy, facilitating trade across its vast territories. However, the value of coins was still closely tied to the intrinsic value of the metal they contained. This created challenges, particularly during times of economic crisis or warfare when governments might debase their currency, reducing the amount of precious metal in coins while maintaining their face value, to finance military campaigns or pay off debts. This practice often led to inflation and economic instability, highlighting the limitations of metal-based currency systems. The next major innovation in the history of money came with the introduction of paper money, a development that fundamentally changed the nature of currency. Paper money originated in China during the Tang Dynasty, 618 to 907 CE, but became more widespread during the Song Dynasty, 960 to 1279 CE. Initially, These were promissory notes issued by merchants and backed by deposits of precious metals or goods. The Chinese government eventually adopted and standardized these notes, making them the first government-issued paper currency in history. The use of paper money spread to the Islamic world and Europe through trade and cultural exchanges. In Europe, however, it took several centuries for paper money to gain acceptance. The first European banknotes were issued in Sweden in 1661 by Stockholm's Banco. These notes were backed by deposits of precious metals, similar to the Chinese model, and represented a promise to pay the bearer a specified amount of silver or gold upon demand. The transition from metal coins to paper money was not without challenges. For paper money to function effectively, people needed to trust that the paper represented real value and that it could be exchanged for something tangible. This trust was often reinforced by the backing of paper money with precious metals, a system known as the gold standard. Under this system, a country's currency was directly linked to a specific amount of gold, which helped stabilize its value and foster international trade. However, the gold standard also imposed constraints on governments, limiting their ability to respond to economic crises or fund large-scale projects without depleting their gold reserves. These limitations became increasingly problematic in the 19th and early 20th centuries as economies grew more complex and the demands on governments expanded. As global trade expanded in the 19th century, there was a growing need for a stable and universally accepted monetary system. This led to the establishment of the gold standard, a system in which a country's currency was directly linked to a specific amount of gold. Under the gold standard, paper money could be exchanged for a fixed amount of gold, providing a stable and predictable value for the currency. The gold standard had several benefits. By tying currency to gold, governments could prevent excessive inflation and maintain stable prices. The gold standard facilitated international trade by providing a common benchmark for valuing different currencies. The gold standard increased public confidence in paper money, as people knew they could exchange it for a tangible asset like gold. However, the gold standard also had limitations. It constrained governments' ability to respond to economic crises, as they were limited by the amount of gold they held in reserve. Additionally, the discovery of new gold deposits or changes in gold production could lead to fluctuations in the money supply and economic instability. The gold standard remained in place in various forms until the 20th century, when it was gradually abandoned in favor of more flexible monetary systems. In 1971, the United States, under President Richard Nixon, made a pivotal move by suspending the convertibility of the US dollar into gold, effectively ending the Bretton Woods system, which had governed international monetary policy since the end of World War II. This decision marked the beginning of the global era of fiat money. Governments introduced fiat money because it gave them greater control over their economies. By not being tied to a physical commodity, central banks could print more money in times of economic downturn to stimulate growth, fund government spending, and manage inflation. In a fiat money system, there is no limit to how much money a government can print. This has led to instances of hyperinflation in some countries, where the value of the currency has plummeted so rapidly that it becomes virtually worthless. Even in more stable economies, persistent inflation gradually erodes the value of money over time, which is often referred to as the hidden tax on savers and consumers. To understand the real impact of inflation and the devaluation of currency, let's look at how the cost of buying a house has changed over the past few decades. In 1970, the average price of a house in the United States was around $23,000. At that time, a carpenter with a steady job could afford to buy a home, support a family of 8, and have a stay-at-home spouse. The purchasing power of the dollar was much stronger, and a single income was often sufficient to cover the basic needs of a family, including housing, food, education, and healthcare. By the year 2000, the average price of a house had risen to approximately $119,000. While wages had also increased during this period, they did not keep pace with the rising cost of housing and other essentials. Many families now required 2 incomes to afford a home and maintain their standard of living. The cost of living had increased due to inflation, but wages had not kept up, making it harder for a single-income household to thrive. Fast forward to 2024, and the average price of a house in the US has soared to around $416,000. The dream of homeownership, which was once within reach for the average worker, has become increasingly elusive. Even with both parents working, many families struggle to afford a home without taking on significant debt. The gap between wages and the cost of living has widened, leaving many people feeling like they are falling further behind despite working harder than ever. This stark increase in housing costs over the decades is a direct result of fiat money. As the government prints more money, the value of each dollar decreases, leading to higher prices for goods and services, including housing. This hidden tax erodes the purchasing power of money, making it harder for ordinary people to achieve financial stability and independence. Today, as we speak, many families find themselves trapped in a cycle of debt, relying on loans and credit to afford basic necessities. The idea that a single income could support a large family with a stay-at-home parent seems like a distant memory, as even two-income households struggle to maintain financial stability. As we continue, be sure to give this video a thumbs up, share it with others who might benefit, and subscribe for more in-depth content on wealth, finance, and achieving financial freedom. The late 20th and early 21st centuries have seen another significant transformation in the history of money: the rise of electronic and digital forms of currency. With the advent of computers and the internet, money has increasingly become a digital entity, existing primarily as numbers in bank accounts rather than physical coins or paper notes. The development of electronic payment systems, such as credit cards, debit cards, and online banking, has revolutionized how people access and use money. These systems have made transactions faster, more convenient, and more secure, enabling the growth of e-commerce and global trade. For example, credit cards, first introduced in the 1950s, have become a ubiquitous payment method, allowing consumers to make purchases on credit and pay off their balances over time. The internet has further accelerated the shift toward digital money, with the rise of online payment platforms like PayPal, which was founded in 1998. PayPal and similar services have made it easier for people to send and receive money electronically, both domestically and internationally, and have played a key role in the growth of the gig economy and online marketplaces. In addition to these developments, the concept of digital currencies has gained significant traction in recent years. Digital currencies are entirely electronic and have no physical form, existing only as data on a computer or blockchain. The most well-known and influential of these digital currencies is Bitcoin, which was introduced in 2009. In 2009, a mysterious figure or group known as Satoshi Nakamoto introduced Bitcoin, the world's first cryptocurrency. Bitcoin wasn't just another form of digital money. It was a completely decentralized currency, free from government control and traditional financial institutions. The concept was revolutionary: a peer-to-peer currency that allowed users to transact directly with one another without the need for a middleman. Bitcoin was built on blockchain technology, a decentralized ledger that records every transaction across a network of computers, making it nearly impossible to alter or hack. Bitcoin's emergence sparked a financial revolution. It wasn't long before other cryptocurrencies, like Ethereum, Ripple, and Litecoin, entered the scene, each with its own unique features and purposes. These digital currencies offered not only an alternative to traditional money, but also a new way of thinking about wealth, investment, and economic freedom. The digital revolution didn't stop with cryptocurrencies. In fact, the way we conduct transactions has undergone a complete metamorphosis. Payment methods have evolved from swiping credit cards to scanning QR codes, using contactless payment methods, and even making transactions through social media platforms. Today, platforms like PayPal, Venmo, and Cash App have become household names, making it easier than ever to send and receive money instantly. Meanwhile, tech giants like Apple, Google, and Amazon have entered the financial arena, offering digital wallets and payment systems that seamlessly integrate with our devices. But the real game changer has been the rise of mobile banking and fintech, financial technology. Traditional banks, once the gatekeepers of our financial lives, are now competing with a new breed of tech-savvy companies that offer everything from online banking to investment apps, budgeting tools, and robo-advisors. These innovations are putting financial power directly into the hands of consumers, allowing us to manage our money with unprecedented ease and efficiency. The story of money is far from over. In fact, as we stand on the cusp of a new era, the future of money is poised to undergo some of the most radical changes we've ever seen. Imagine a world where the very concept of money is redefined, where your wealth isn't just a number in a bank account, but something far more fluid, secure, and integrated with the technology that powers our daily lives. So, what does the future of money look like? Let's take a journey into the possibilities that lie ahead, and I'll ask you to think about how these changes might shape your life, your wealth, and the way you interact with money. Imagine a digital version of the money you use every day, only this time, it's not just numbers on a screen, but an entirely new form of currency issued directly by your government. Central bank digital currencies are just that, digital representations of a country's fiat money, backed and regulated by the central bank. Governments around the world are already exploring the potential of central bank digital currencies, with countries like China, Sweden, and the United States leading the way. The introduction of could revolutionize the global financial system, making transactions faster, reducing the risk of fraud, and even providing a way for unbanked populations to participate in the economy. But with this power comes questions. What happens to privacy when every transaction is potentially visible to the government? How do we balance the benefits of digital efficiency with the need for personal freedom and security? What if you could borrow, lend, or trade without ever stepping foot in a bank? What if you could earn interest on your assets without relying on traditional financial institutions? This is the promise of decentralized finance, a movement that is reimagining the financial system from the ground up using blockchain technology. Decentralized finance platforms operate without intermediaries. Instead of relying on banks or brokers, they use smart contracts, self-executing contracts written into code that automatically enforce the terms of an agreement. This means you can engage in financial transactions directly with others in a way that's transparent, secure, and accessible to anyone with an internet connection. The implications of decentralized finance are profound. For the first time, financial services are becoming truly global and open to everyone, regardless of their location or financial status. It's a shift towards a more inclusive economy, where people have more control over their own money and investments. But decentralized finance also comes with its own set of challenges. The lack of regulation and oversight can lead to volatility and risk. Additionally, the technology is still in its infancy, and there are concerns about security and scalability. However, as decentralized finance matures, it could pave the way for a financial system that's more democratic, resilient, and innovative. Imagine buying a house without the need for lawyers, escrow accounts, or even paperwork. Instead, the entire transaction is handled automatically by a piece of code that ensures every condition is met before the deal is completed. This is the potential of smart contracts. Smart contracts are one of the most exciting developments in the future of money. These self-executing contracts live on the blockchain and automatically enforce the terms of an agreement without the need for intermediaries. They could revolutionize industries by making transactions faster, cheaper, and more secure. In real estate, for example, smart contracts could automate the entire process of buying and selling property, from verifying ownership to transferring funds. In insurance, they could automatically pay out claims when certain conditions are met, reducing the need for lengthy claims processes. In supply chain management, they could ensure that payments are made only when goods are delivered and verified. The potential applications are endless, and as the technology improves, we could see smart contracts become a fundamental part of how we conduct business and manage wealth in the future. As we look ahead, one thing is certain: the evolution of money is far from over. We are entering an era where money is not just a tool for commerce, but a dynamic, evolving force that will continue to transform our lives and society. The future of money will be shaped by the choices we make today, from how we embrace new technologies to how we address the challenges of privacy, security, and sustainability. So, what do you think the future looks like? How will these changes affect the way you save, spend, and invest? The answers to these questions could determine not only your financial future, but the future of money itself. Thank you for joining me on this journey through the future of money. If you found this video thought-provoking, don't forget to give a thumbs up, share it with others who might be curious about what lies ahead, and subscribe to The Bag for more insights on wealth, finance, and achieving financial freedom. The future is unfolding before us. Make sure you're ready to be a part of it.